Guys, I'd like to inform you that students can practice Excel exercise using the YouTube video clip posted on the module page. I'm going to post it on the module page under the class materials and from the week 9 that we started the Zoom class. So notice that this just a 10-minute video clip is not an alternative of Zoom class, but rather is to enhance the class effectively and efficiently. A couple of challenging classwork will be covered through this short video clip in each chapter, and they are going to help students practice alone at home after attending the class. Thus, if you didn't come to the Zoom class, please carefully read the class notes posted on the module page first and clearly understand the concept. And then come back to this other video clip to work on a step by step with me. Otherwise, you're not going to understand. You couldn't understand what's going on this video clip. Okay, so let's start with the short-term notes payable. During the class, we discussed about this concept. A little bit challenging, but if you catch the point of this, the recognition of interest expense and interest payable, it's not hard. It's not difficult. The point is, we have to record the accrual, interest expense, and interest payable at the fiscal year end. For example, the September 30, year 1, we borrowed short-term note payable, 12-month borrowing for $10,000 with 10% interest rate. Then we pay principal and interest at maturity. But the problem is that at the fiscal year end, when you close the book, December 31st, year 1, we have to recognize the borrowings, the interest, the expense we have been using. How long month? Right, 3 months. When do we recognize the expense? Right, when it occurs, when we use it. So 3 months interest expense, how do we get it? 250, like this, okay? And then we should recognize. But we do not pay this interest amount. Why? Because at the end of the day, we will pay the note payable and the interest at once. So we should not recognize any cash payment. Instead, we use the interest payable account. Then let's jump into the exercise. My company purchases smartphones for sales, $10,000 by issuing a short-term note payable that pays 10% interest and due in 1 year. It occurs on September 30, right? So what account do you need? Yes, inventory, $10,000. Asset up on the journal entry rule. Then short-term note payable. Short-term note payable, how much? And the same amount, $10,000, which is liability up on the credit. On the fiscal year end, now we have to close the book. Then we should recognize accrual of interest expense because we have been using this $10,000 borrowing for 3 months. So what account do we need? That's right, interest expense. How much? 10,000 times 10% times 3 months divided by 12 months. Okay, and then the other side, again, we do not pay cash. Instead, we just recognize cash to pay. So interest payable, 250. Payable means cash to pay. When do you recognize expense? When we use, when it occurs. So 250 interest payable, we recognize. And then when you pay interest at the maturity, we cancel this interest payable next year. Okay, so the company paid the note payable and the interest at maturity on December 30th, year 18. Then what account do you need on the credit side? Cash. Principal 10,000 plus 10,000 times total amount of interest. So 11,000. Then we have to cancel this 10,000 out because we paid this 11,000 includes this $10,000 payable. We already paid. Do you want to have the payable? Do you want to have obligation when you pay? No, we have to get rid of this, the liability account, by putting on the credit side asset down on the credit and liability down on the debit side. Interest payable, we need interest payable as well because 250 also is included in the $11,000, the total payment. So we should reduce this amount. And then the second point is the interest expense recognition for 9 months. Why? Because we have been using $10,000 for 9 months at the fiscal year 18. So we should also use interest expense account. And how much is it? $10,000 times 10% times 9 months divided by 12, right? Or just you can just simply use 10,000. 10,000 is total interest expense we calculated here, and minus just 250. That amount is the same amount for 9 months interest expense. Now, once we finish this journal entry work, let's post all the journal entry work on the balance sheet and income statement for 2 years because we need 2 years financial statements following the journal entry. So first the transaction on the September 30th. Okay, the inventory up. We purchase inventory on the asset, and then short-term note payable, $10,000. At the fiscal year end, December 31st, interest expense negative because expense is negative on the income statement. And interest payable 250, liability up. So I think we've done these 4 transactions on the balance sheet and income statement. So let's link this net income, assuming that we don't have any other transaction. 250 net income should be accumulated on the retained earning. And then let's check up to see if the total asset is balanced out with the total liability and equity. So $10,000 on the total asset, and the sum of these 3 account liability plus equity. Okay, $10,000 clearly matched. On the second year, okay, before starting this work on the second year transaction, we have to remember that all the ending balance of prior year is the same as the beginning balance of the next year. Yeah, because the balance sheet is recorded as of. So as of means we include all the balance, the value of balance from the start of the business to now, as of now. So the beginning balance of cash or the inventory ending balance of the prior year is the same as the beginning balance of the second year. Then all the numbers should be started from the beginning balance of the year 18. Okay, But you should clearly understand this. The income statement is recorded for the year ended. That means that just 1 year transaction, 1 year business activity. So it is not cumulative. So don't link any the value from the prior year balance on the income statement to the next year. Anyway, we will accumulate all the net income to the retained earnings. Okay, so you don't have to do that. Okay, we set up all the balance sheet and income statement before linking the journal entry. Certain note payable. Okay, let's start from the cash. 11,000. We have to now reduce $11,000 cash out. Then the short-term note payable on the debit side means liability down, interest payable down, and then the expense, the debit side, expense negative. So the short-term note payable we should cancel out because we paid. And then interest payable also we have to cancel out. Then what else? Interest expense 750, negative 750. Okay, then assuming that there's no other transaction, let's accumulate this net income on the retained earning. Good. Then let's check up 11 and 10,000. Then we have $1,000. So we create 2 years the finance statement through this accrual interest expense recognition. Very good job. See you next video clip. Bye-bye.